Today, spring has not sprung this year. Hello again, it's Martin North from Digital Finance Analytics, where's my latest post covering finance prop news with a distinctively Australian flavour. I want to talk about the low volumes in the property sector today because this is becoming a very significant issue and frankly it's messing with people's minds. Now, the number of new listings being added to the combined capital housing markets has seen a hefty 44% rise from the depths of the winter slowdown in early July through to the first week of October. However, that hasn't been enough to push fresh listing numbers in line with previous years, says CoreLogic. The number of new capital city listings over the past 28 days was tracking at the lowest levels for this time of year since CoreLogic started tracking real estate listings in 2007. 22,939 fresh real estate listings were added to the capital city housing markets over the past 28 days. That's 13% lower than the same time last year and 15% below the 13-year average. New stock levels are down across every capital city, with the largest fall in Darwin, where newly advertised listings are 36% lower than a year ago and 63% below the heights recorded back in 2007. Darwin housing conditions have been weak since the middle of 2014, so it's understandable that homeowners would be reluctant to list their property under such challenging selling conditions. But CoreLogic says you can't apply that same logic to stronger markets. Properties in Hobart are averaging just 28 days to sell, and homes are selling on average in less than 50 days across Melbourne, Sydney and Canberra. Yet vendors seem to be lacking confidence to put their homes on the market, with new listing numbers down in these cities also. Auction clearance rates remain high across the main auction markets and prices are under renewed upward pressure, although how much, of course, is a matter of dispute at the moment. So we need to ask the question, why is there a lack of new listings in cities where housing market conditions are perhaps picking up? CoreLogic said it's reasonable to expect that there would be some level of pent-up demand among homeowners who were unwilling to sell during the downturn and were waiting for selling conditions to improve. Potentially, a partial explanation can be found in persistently low levels of consumer sentiment. The Westpac Melbourne Institute Index of Consumer Sentiment recorded its lowest reading since 2015, and we discussed this yesterday in our recent post. With Australians increasingly concerned about their finances and the economic outlook, it may be the case that prospective vendors are choosing to sit on their hands until they feel more confident. A property transaction, whether it be an option to sell or to buy, is a high commitment decision that is much harder to make during periods of uncertainty. Another explanation CoreLogic is suggesting is the recency of the improved market conditions. Capital city dwelling values were still trending lower only 3 months ago, and the change to more positive conditions wasn't widely anticipated. CoreLogic said, realistically, it can take some time for homeowners to get their affairs in order and to prepare their property for sale. With this context, a lag between the improved market conditions and a more substantial rise in new listings isn't at all surprising. Another barrier that may be preventing a more significant lift in listing numbers is high transaction costs, especially if the homeowner is downsizing or upgrading, which would incur a stamp duty payment. And with market activity rising, active buyers are becoming more competitive across a shallow pool of listings, which is adding some urgency to the market. With increased competition, vendors are regaining some of the leverage they lost through the housing downturn, and buyers could be feeling the first pangs of FOMO, fear of missing out, as they see properties selling faster and prices rising. Historically, the seasonal peak in new listing numbers is around the second week in November, so there is still some time for the spring, early summer listing season to ramp up, CoreLogic said. Well, maybe. But I need to come back to my household surveys and what I've seen there. there's been a significant swing in the last 2 months. We actually went through quite a positive upswing after the election and before the rate cut started, and there was a significant rise in the number of people who were saying that they were considering putting their property on the market to trade down, to first time buy, or indeed even to consider property investment. But that seems to have changed in the last 6 to 8 weeks. And what's happened in that time? Well, it's the cut in interest rates, which has really, I think, scared the horses. And therefore, my theory is that we're not going to see a significant rise in the number of listings in the next few weeks. And indeed, the little spike in sales that we saw, and maybe the little spike in price up over the last few weeks, is perhaps temporary. Because the fundamentals are these. Households are under pressure financially. Many are actually sitting on negative equity now. And the future prospect of more capital growth is still a mirage for many, particularly in units and particularly in the outer suburbs. As a result of all this, my own view is it's going to be quite unlikely to see anything like a property rebound, and I'm still quite suspect about the true state of home prices, but we'll see over the next few weeks. I'm Martin North from Digital Finance Analytics. Thanks for watching, and I'll see you again next time.